You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we're getting right into the heart of earnings season. And last week, we looked at a butterfly in United Healthcare, symbol UNH. We're going to keep that theme today, and we're going to take the trade that on paper was successful last week, and we're going to apply that concept to one of the FANG stocks, Netflix. So over the next couple of weeks, we're going to be looking at a lot of the FANG stocks, not because they're technology stocks, mainly because they are high price stocks. And I think the favorite thing of most option traders is to have some juice to work with in your option contracts. So when you throw in the fact that you got a high price stock, and then you throw in the fact you got to pump up and vol because of earnings coming out, it just makes for a fun trading scenario. Now, the true fun is only determined after the trade to see where you land on. But most people, if you manage your risks, just like a good option trader, you formulate a plan and you stick to the plan, you should always be happy. As they say, as a fisherman always says, a bad day of fishing is always better than a good day at work. So that's the concept that we're going to look at here. And we're going to get into Netflix, and we're going to look at almost the exact same type of trade that we did in United Healthcare. So I'm going to recap the trade from last week. The trade was very simple. United Healthcare was very cordial to us after we put on the butterfly. It really did absolutely nothing, and that's what we were looking for in United Healthcare. So here's the trade. United Healthcare is going to be announcing earnings on the 16th of April, and today, the day that we put on the trade, was the 4th of April, which was a Wednesday. The market was closed, and we were hoping that by Friday we'd get some huge time decay in the underlying stock, and that the market would stay somewhere within our range of our butterfly, stay within the range of our wings, and we could just do a real quick, a friend of mine calls it time bomb butterfly, where you get some huge time decay and you can get out of the trade. And so here was the trade. The market on April 4th on the close was at 228.79. We came in and we did a 7.5 point wide butterfly, and that's just looking at the expected move around earnings. So we felt pretty comfortable because we weren't going to ride this to earnings. And we bought the 222.50 call, the 222.50, went up 7.5 points, and we sold 2 of the 230 calls, and then went 7.5 points higher, did a standard butterfly, and bought 1 of the 237.50 calls. Okay, we did that entire trade for a net debit of $3.68, And our maximum upside on the trade was $3.82. We were only going to stay in it for one day, see where the time decay went. And what happened in United Healthcare the next day was, almost over the last 3 or 4 weeks, it was the lowest trading range that the chart says happened in United Healthcare. So the next morning it opened at 229.46. The high for the day was 231, rounding off. The low was 226, and it closed at 229.07. So basically just a hop, skip, and a jump above where we put it on, and it went in the right direction. It went towards our short strike, which was 230. So if you would have stayed in the trade, you could have made close to $1 just in time decay over the entire day. But we said you should get out when you're up 50 cents. And if you didn't get out when you were up 50 cents, it means you didn't stick to your plan. And we like to give you the stupid word when you don't stick to your plan. So basically that trade was very simple. We're done. We had some success with it. So let's take that concept. And since we're kind of waiting around for the FANG earnings to do something specifically around with an expiration after their earnings report, we're going to go and set the same trade up in Netflix. So let's do it. So in this instance, it's April 11th. Once again, it's a Wednesday. The market is closed, and we are looking at the April 13th Netflix expiration. So we got 2 full trading days, all day Thursday, all day Friday. And the thing about Netflix is it's a more expensive stock. And because of that, and it's a more volatile stock, this is a little bit more riskier paper trade. But then again, it's a paper trade. We're just trying to learn on this. Nothing on Options Playbook Radio is meant to be a recommendation. It's just all about learning. And if I looked at the Netflix expected move because of the volatility in it after earnings, they're looking for about a 10-11% move, which is 30 points. I'm not going to go that wide because a 30-point butterfly is just too much. It's going to be $12, $13, and I just don't want to talk about that on Options Playbook Radio. So I chose to go with a 15-point butterfly on Netflix. All right. So here's the scenario. Netflix today closed up $5.60. The last trade was 303.67. $303.67. The most at the money strike is the 32.50 strike call option. We're going to stick with the calls. It doesn't really matter. You could do it with the puts because we're centering it around the money. We're going to do a standard butterfly, 15 points wide. So the lowest strike call that we're going to buy is the 287.50. And then our protection wing on the upside is 317.50. So we're 15 points wide. We're going to put this entire gaggle of options on, hopefully at the midpoint. Now, remember, the market's closed of $6.86, but it's around earnings. Markets are very liquid right now, so I would assume that we could get a fill fairly close to that. Let's call it $6.90. You can't always get a midpoint fill, but that's what we're going to call it for today. Now, I'm going to emphasize this is not an earnings trade. We're just trying to take advantage of the fact that we just got some juice in general in the marketplace. It just makes it if you're not trading options when there's juice in the options in the marketplace, hedge strategies, then you're not really an option trader in my mind, especially if you're doing short-term trading. But just for example, the April 13th expiration has a 46% implied volatility, where the actual expiration that contains earnings, the April 20th expiration, is trading around an 82% implied volatility. All right, so we got a lot bigger skew. I like the United Healthcare trade better because the skew the tilt between the expirations was a lot less. I think it was 5%. And that was part of the reason why we leaned that way. But I want to see how this trade plays out too. United Healthcare turned out to be a perfect scenario. But we're going to try this on Netflix and be a little courageous here. We got a little bit more upside. We're doing it. Last week's trade was about a 50-50 bet as far as max loss versus max gain. We're doing a 15-point wide butterfly this time around. We're going to say that we can get it done for $6.90. That means that we actually have $6.90 worth of risk, and we have $8.10 worth of upside. Okay. Once again, when we're doing this type of trade, we're never looking to make that $8.10 because ideally that means you have to stick around right until expiration, and the market has to stop right at that middle strike of $302.50, $302.50. And that takes a small miracle to make Netflix stop right there at expiration. So once again, what are our risk parameters? We're spending a little bit more, so I'm willing to risk a little more. I'm hoping to make at least 75 cents or $1 as opposed to 50 cents last week. We got more skin in the game, and we would expect more time decay, as what's 1 day's worth of Netflix time decay worth is what the real question is. So in this scenario, we once again, let's recap the trade. Let's reset and look at what our parameters are, what our goal is on this trade, and when we're going to get out of the trade. So we are looking at the April 13th expiration. Netflix is going to announce earnings on April 16th. The implied volatility of the Netflix trade, of the options we're trading right now, the at-the-money implied volatility is 46%. The expected move in the short term is $9. The expected move with the earnings on the April 20th is $32. So quite a bit of difference. But $9, we're going 15 points wide. So we're feeling fairly comfortable if the market's expecting that. We're hoping for less than the expected move. That's your whole goal on this trade. And this is one of the times when you want to look at trades like this, because the concept is that a lot of times stocks will slow down getting ready for earnings. And that happened last week. Now we're hoping that it will happen this week. It's a purely time decay play. Implied volatilities, we're kind of hoping just stick in the same range, but we're looking for a huge rate of time decay before that Friday expiration date. So 2 full days of trading. So we're buying the April 13th expiration 287.50 call, going 15 points higher, selling 2 of the same expiration 302.50 calls, and then buying 1 of the same expiration 317.50 calls in Netflix 2 days to expiration. The net debit, we're hoping to get the midpoint of $6.90. That would be our max risk on the trade. Our risk parameters are, we're looking to make 75 cents to $1. If by any means Netflix touches one of our long strikes, one of our hedging strikes, we're out of the trade for sure. But bottom line is, on the downside, if you're looking to make $1 on the upside, you probably want to get out when you're going to lose about $1 on the downside. That's what a lot of people like to do when they do these type of trades. You got a lot of things working for you. You got time decay on your side, and you're just hoping that it will work. But never let it get outside of your strikes, because if it does, first of all, it's made quite a bit bigger move than the expected move, and that should make you nervous anyways. The expected move is 9 points. We're looking at 15 points. But this premium that is in these option contracts, when you're wrong, it also helps you, and it gives you a benefit. So we're hoping ideally that it stays within the 10-point range by tomorrow, and we can get out of this trade and be at a profit. And that's going to be it for this episode of Options Playbook Radio. Well, next week when we come back, we'll look at the Netflix trade, and then they'll be announcing earnings. So we'll actually look at a fairly advanced trade around earnings. We'll either look at a back spread or we'll look at a skip strike butterfly going into earnings on Netflix. Those are the 2 trades we'll evaluate, and that evaluation will be based on, do we think it's going to make more than the expected move or less? So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show, or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook was brought to you by Trade King Group. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to tradeking.com/ODD to review additional risks involved with trading options. Securities offered through Trade King LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.